So what is a long butterfly? So the definition that is well known of what a long butterfly is, that it's an option strategy, first of all. It has equal width bull and bear spreads. Now, this is a particular type of long butterfly that we call a symmetrical butterfly, where it's made up of two spreads, a bull spread and a bear spread, and they both have exactly the same width, and they share a short strike. So when you put the risk graph together, it looks like a pyramid with feet. Some people say it looks like the bottom part of a butterfly. Now, the strategy itself, for most of my life in trading, people have traded it as a market neutral strategy. However, it is way more effective as a directional strategy. As a market neutral strategy, in the same way that the iron condor is a market neutral strategy, the risk to reward just isn't there. And although the amount of premium collection that you can get from it, that's another feature of the butterfly, can be quite explosive. However, because you have such a narrow base from which to work with, just the way the butterfly is constructed, and that larger risk, making it a market neutral strategy is definitely not the best way to go. So we turn it into a directional strategy. It has fixed risk and capped profit, and it can either be 4 calls or 4 puts with 3 strikes with the same expiration date. So a long butterfly can be either all calls or all puts. Now, it's possible to also have another type of butterfly called the iron butterfly, which is more like an iron condor, but essentially it is an iron condor where you share the short strikes, and there you have a short call spread, which would be bearish, and a short put spread, which would be bullish. And then when they share their short strikes, they create something that looks just like a long butterfly. In fact, an iron butterfly with the same strikes is exactly the same as a long call butterfly or a long put butterfly with the same strikes. It will act the same, it has the same risk, the same reward. Everything about it is exactly the same, other than the way it's constructed. All right, so this is showing how these butterflies would come together. So here you have a long call vertical on the left, and then a short call vertical. This would be a long call butterfly. So combined, it's long because it produces a debit, not a credit. So when you put it together, they share the short strike. See right here, you see 4,500 and 4,500. This is just showing it apart. So when it comes together, it looks like that triangle that we're all used to seeing. So when you put it together, it looks something like this. And if you're at the money, that risk, here I'm showing a 1 to 5 risk to reward, which is not typical. That would be extremely good. This is probably in a very high volatility environment, taken very early in the strategy's life cycle, that you could get a 1 to 5. On a 0 DTE day, trying to get something at the money like this, a 1 to 5 risk to reward would be virtually impossible. It would be more closer to 1, maybe 1 to 2. This particular fly is 5 wide. So if you were to think, how do you calculate the max profit? The max profit is the width, 5, and because it's an option, you multiply that by 100, so that's 500 minus the debit. In this particular case, the debit is 100, so that would be 500 minus 100, so the max reward is 400, and you can see that over here. So that's how you figure out the max profit. That's the width minus the debit. So here's a variation of the butterfly. This is where you don't have symmetrical wings. These would be asymmetric wings, and a lot of people won't wonder, why don't you do these, Ernie? And as a directional strategy, you have hardly any risk over here, increases your risk to reward, and all the risk is put further out. The problem is that we could potentially go out here and experience that risk. So we would prefer not to do that. This also creates a different type of profit curve in between here that acts in a way that is not conducive to day trading. The profit curve is falling away from us, so it doesn't give us a strong edge, unlike the symmetrical fly. And then finally, this is the difference between creating a neutral strategy, like on the left. You can see the risk is sometimes and usually bigger than the reward when you put the butterfly at the money. So market price equals the short strikes, right? So we don't like that. What we like is to push it out. So this would the market price or the current price, and then we push the fly out of the money. And what this does is it changes the whole risk to reward equation. So our risk is very small compared to the reward, which is very big. So that's how we start off. So here's some basic rules for entering the butterfly. Man, we're almost at the market close. I haven't even looked at it. And this is just the entry rules. And on the next installment or the next module, module, we'll go over more detail about how you manage the butterfly. But very simple. Buy a 15 to 30 wide long fly soon after the market opens. This is what we do. Select a directional bias. Some like to use the 50-day EMA. So in other words, if it's below the 50-day EMA, go bearish. If it's above, go bullish. Bearish, you buy a long put fly. Bullish, you buy a long call fly. Although realistically, it doesn't make a difference one way or the other. You could use all put flies or all call flies, but by convention, we use put flies for bearish ones and call flies for bullish ones. They would be the exact same strategy. Just that sometimes you might have, because it would be so far out of the money, trying to do a call fly in a bearish situation, the liquidity might not be there. But with the SPX, that's not an issue. Anyways, we just do it by convention. Put fly for bearish and call fly for bullish. We buy out of the money with a 1-to-9 risk to reward. That's the key. A 1-to-9 risk to reward. So essentially what we're saying is that we make the debit 1/10 the width, and that will give us that 1-to-9. And that's what I'm showing with this formula, how you first figure out the max profit and then divide that max profit by the debit, which is our risk. And that gives you the risk to reward. An example of that, of say a 20 wide, that would be $2,000 potential profit. And let's say that its debit was $200. So $2,000 minus 200 is $1,800, right? And so $1,800 would be the max profit of that fly, a 20 wide with a $200 debit. And then you divide the debit into that price, that max profit, and you get the risk to reward. In that case, it would be 9. So shorthand, basically we say that just make to get a risk to reward of 9, that's the key, is to just put the fly on in such a way that the debit is 1/10 of the width.